In 1929, while the stock market was vaporizing $30 billion in a matter of weeks, one family was quietly buying. Not selling, buying. While ticker tape piled ankle-deep on the floor of the New York Stock Exchange, while men in good suits were jumping from windows, the Rockefeller family, through a private vehicle most Americans had never heard of, was purchasing land, office towers, and equity positions at prices that would look absurd within a decade, because they'd look like nothing compared to what those assets would be worth 20 years later. This wasn't luck. It wasn't a lottery ticket. It was a plan that had been assembled years before the crash, sitting quietly, waiting for exactly this moment. That's the part nobody tells you about old money. It's not just that these families have more, it's that they have a different relationship with collapse itself. To most households, an economic crash is a catastrophe that happens to them. To a small number of multi-generational families, it is a recurring, almost scheduled event, one they've built entire systems to survive, and in some cases, to profit from. Today we're opening the playbook, not the aesthetic, the actual mechanical architecture that lets certain families walk through a depression, a currency collapse, or a banking crisis relatively unscathed, while everyone else is rebuilding from zero. This isn't hidden, it's just never taught. The crash instinct, why old money sees collapse differently. Here's the first thing you need to understand. Families that survive multiple generations of wealth don't think of economic collapse as an anomaly. They think of it as weather. Ordinary financial planning treats a recession as a rare, unfortunate event, something you insure against the way you might insure against a house fire. Dynastic financial planning treats economic contraction as a certainty that will arrive roughly once every human generation, sometimes twice, and builds the entire structure of the family's holdings around that assumption from day one. This mental shift changes everything downstream. If you believe a crash is unlikely, you optimize for growth. If you believe a crash is inevitable, you optimize for survival first, growth second. And once survival is secured, growth becomes almost automatic, because you're one of the only players left standing when the buying window opens. Consider the Fugger banking dynasty of 16th century Augsburg, sometimes described as the wealthiest family in European history at its peak. The Fuggers extended enormous credit to the Habsburg monarchy, a relationship that eventually became their undoing when the Spanish crown defaulted. The lesson the family took from watching that collapse unfold, hedged here because sourcing on the internal decision-making of a 500-year-old private banking house is thin, was one that echoed through European merchant banking for centuries afterward. Concentrated exposure to a single sovereign borrower, however prestigious, is a structural vulnerability, not a safety net. Compare that to the Rothschild family in the years surrounding the Battle of Waterloo. Whatever the precise mechanics of their positioning, and the popular Rothschild made a fortune on advance battle news story has been repeated so often it has drifted well past what can be verified. The underlying structural truth about the family's operation in this period is well documented. They ran an information network faster than most governments' own courier systems, with brothers stationed in different capital cities, relaying intelligence by private courier and carrier pigeon. Whatever specific trades came out of it, the broader capability, knowing what was happening in European markets before your competitors did, was the actual asset. Speed of information became a form of wealth in its own right. This is the first pillar of the crash instinct. Families that survive collapse treat information asymmetry as infrastructure, not luck. The second pillar is what we might call anti-consensus positioning. When everyone in a market is euphoric, dynastic capital gets quiet. When everyone is panicking, dynastic capital gets active. This sounds simple. Buy low, sell high is printed on coffee mugs. But the actual discipline required to act on it is enormous, because it means doing the emotionally hardest thing at exactly the moment it feels most insane. Selling into a rally when the headlines are calling for infinite growth. Buying into a crash when the headlines are calling it the end of the financial system as we know it. Family offices that have survived multiple downturns build this discipline structurally, not just psychologically. They set predetermined liquidity reserves specifically earmarked for crisis buying, money that is not allowed to be touched for ordinary spending, ordinary investment, or ordinary opportunities, no matter how attractive those opportunities look in a normal year. It sits deliberately underperforming, waiting for the one event that makes it the most valuable capital in the family's entire portfolio. We'll get into the mechanics of exactly how that reserve is built and protected in Section 3. But the mindset has to come first, because without it, no family sticks to the plan when the pressure actually arrives. It's one thing to say, we'll buy during the next crash, in a calm boardroom in a good year. It's another thing entirely to actually deploy capital while your peers are liquidating everything they own, and the news is telling you the world is ending. This is where multigenerational education becomes a financial tool rather than just a cultural one. We've covered in previous episodes how old money families train children from a young age in delayed gratification and unglamorous financial habits. See, 12 financial habits. Old money children learn before 18. What we haven't covered yet is how that same training gets weaponized during an actual crisis. A 28-year-old heir who was taught at age 9 that market panic is a buying signal, not a running signal, behaves completely differently in 2008 than a 28-year-old who has never been told anything except protect what you have. If this kind of mechanism first breakdown is useful to you, subscribing genuinely helps. This channel exists specifically to explain the parts of wealth that get left out of the aesthetic content. Hit subscribe now so the next breakdown lands in your feed automatically. Asset architecture. Building a portfolio that doesn't care what currency says. Once the mindset is in place, the next layer is structural. What do you actually hold and why? The average household's net worth is dangerously concentrated in a single asset class, usually a primary residence, financed with debt, denominated in a single currency, in a single country, subject to a single national economy's fortunes. If that country's currency inflates, that job market contracts, or that housing market corrects, the household absorbs the full impact with no offsetting position anywhere else in their financial life. Old money portfolios are built to explicitly avoid this single point of failure. The architecture typically spreads across 5 categories that behave differently under economic stress. Hard, non-yielding stores of value. Gold has held this role for millennia for a simple structural reason. It has no counterparty risk. A bond can default. A currency can be devalued by policy decision. A stock can go to zero. Gold just sits there, chemically inert, uninterested in anyone's monetary policy. Old money families typically hold a meaningful allocation to gold and, increasingly in the modern era, to other hard assets. Not because they expect it to outperform in good years, but because they know it will hold value in the specific years when everything else doesn't. Land and hard real assets held free of debt. Note the distinction, free of debt. This is a critical detail most people miss when they hear old money owns real estate. Leveraged real estate is one of the most dangerous assets to hold during a credit crunch because when banks tighten and refinancing dries up, over-leveraged property owners become forced sellers at exactly the worst moment. Old money real estate holdings tend to be either fully paid off or held at extremely conservative loan-to-value ratios, specifically so the family is never forced to sell into a down market to service debt. We covered this dynamic in depth in our episode on real estate as dead capital. The framing there was about opportunity cost in good times, but the flip side of that same low leverage posture is what makes the asset a fortress in bad times. Collectibles and art, frequently stored in Freeport facilities. We've discussed Freeports before as tax-efficient storage, and that's true. But their function during economic collapse is different and arguably more important. Art and rare collectibles are among the few asset classes whose value is largely uncorrelated with public equity or bond markets. A masterwork doesn't lose 40% of its value because a central bank raised interest rates. It's illiquid, which is normally a weakness, but during a crisis, illiquidity that comes with genuine scarcity value becomes a feature. It can't be margin called, it can't be redeemed in a bank run, and its long-term value is tied to something outside the financial system entirely. Operating businesses with pricing power, family-controlled businesses that sell something people need regardless of the economic cycle, agriculture, essential infrastructure, certain categories of manufacturing, tend to be treated as core holdings precisely because their revenue doesn't evaporate the way discretionary consumer spending does. This is different from owning stock in a public company. It's about controlling the operating entity itself, with the flexibility to make decisions a passive shareholder never could. And finally, geographically diversified sovereign exposure, which we'll cover as its own section, because it deserves one. What ties all 5 categories together is a single underlying principle. No single government, currency, or market gets to unilaterally decide the family's fate. A currency collapse in one country doesn't touch gold sitting in a Swiss vault. A stock market crash doesn't touch a debt-free apartment building generating rental income. A banking crisis in one jurisdiction doesn't touch an operating farm in another. This is fundamentally different from the diversification most retail investors are taught, which usually means own some stocks and some bonds. That's diversification within the financial system. Old money diversification is often diversification away from any single financial system's ability to fail all at once. There's a phrase used inside a number of family offices, hedged here, because it circulates informally and isn't attributable to any single documented source. That captures the philosophy well. Never let one government's mistake become your mistake. Whether or not that's the exact original phrasing, it captures a real and well-documented posture. Multigenerational capital treats sovereign and currency risk as something to actively manage, not something to passively accept. The liquidity reserve. Why cash is a weapon, not a waste. There's a piece of conventional financial advice that sounds smart and is, for old money families, almost exactly backward. Cash is a wasting asset because inflation erodes its value, so you should always be fully invested. That advice makes sense for a household optimizing for maximum 30-year returns with no other constraints. It makes considerably less sense for a family whose actual objective is surviving multiple economic cycles without ever being forced to sell a core asset at the worst possible moment. Old money families typically hold what's sometimes referred to internally as a dry powder reserve, a deliberately oversized cash and cash equivalent position that, in a normal year, looks almost irrationally conservative. Financial advisors trained on modern portfolio theory frequently push back against these reserves, arguing the family is leaving returns on the table. And in any given ordinary year, they're right. But the reserve isn't there for ordinary years. It's there for the handful of specific weeks, every decade or two, when asset prices are cratering, credit is frozen, and the sellers who are most desperate are selling at prices that will look like generational gifts in retrospect. Families with dry powder in 2008 bought commercial real estate, quality equities, and distressed debt at prices that, within 5 years, had recovered and then multiplied. Families without dry powder, even wealthy ones, if they were fully invested and over-leveraged, were often forced sellers themselves, liquidating assets to meet margin calls or cover expenses at the exact moment those assets were cheapest. This is the mechanism behind a pattern you'll notice if you study wealth concentration after every major downturn. The gap between old money and everyone else tends to widen during crises, not narrow. It's not because old money is smarter about calling the bottom. It's because old money is structurally positioned to be a buyer instead of a forced seller when the bottom arrives. There's a second function of the liquidity reserve that's less discussed: optionality in a credit crunch. During a genuine banking crisis, credit doesn't just get more expensive. It frequently becomes unavailable at any price, even to people with excellent collateral, because banks themselves are trying to preserve their own liquidity. A family with a large cash reserve doesn't need to borrow during exactly the period when borrowing is hardest, and they can complete acquisitions, cover operating shortfalls in family businesses, and support heirs through disruption without ever touching a credit market that's effectively frozen. This connects directly to something we've covered before in the context of buy, borrow, die. The strategy of borrowing against appreciated assets rather than selling them to avoid triggering capital gains taxes. What's less discussed is the mirror image strategy that sophisticated families use heading into a downturn, deliberately reducing leverage before a crisis, not after one. Family offices that pay close attention to credit cycles, rising corporate debt levels, yield curve behavior, credit spread widening, will proactively pay down leverage positions well before a downturn becomes visible in headlines, precisely because leverage that looks efficient in a bull market becomes existentially dangerous in a bear market, when asset values are falling and lenders are calling in credit lines simultaneously. The uncomfortable truth here is that this requires giving up returns during good years in exchange for survival during bad ones. And that trade-off is psychologically much harder than it sounds, because it means underperforming your peers, sometimes for years at a stretch, while everyone else appears to be getting richer faster. Old money discipline isn't really about knowing what to buy. It's about tolerating years of looking conservative, even foolish, in exchange for being the only capital left standing when the music stops. If you want the deep dive on how families structure debt to avoid ever being a forced seller, including the mechanics of buy, borrow, die, that full breakdown is linked in the description, and it pairs directly with what we just covered. Drop a comment with which mechanism from this video surprised you most. It helps this channel more than you'd think when the algorithm sees genuine discussion happening. Geographic diversification. Why no dynasty? Bets on one country. If you've spent any time researching old money families, you've probably noticed a recurring pattern. Multiple passports, property scattered across several continents, bank relationships in more than one jurisdiction, children educated abroad. This often gets framed in aesthetic-focused content as a lifestyle flex, worldliness, sophistication, the global citizen image. That framing misses the actual function. Geographic diversification, for a family that has survived multiple generations, is a risk management system, and arguably one of the single most important ones in the entire architecture, because it's the one layer of protection that specifically defends against the risk everyone underestimates: their own government. Every sovereign nation has, at some point in its history, done at least one of the following to its own citizens' wealth: suspended currency convertibility, imposed capital controls preventing money from leaving the country, devalued its currency to inflate away debt, frozen bank withdrawals during a crisis, or, in extreme but well-documented cases, confiscated private assets outright, including gold, during a national emergency. The United States itself required private citizens to surrender gold holdings during the Great Depression, a policy that remained in effect for over 4 decades. This isn't a fringe historical footnote. It's a documented instance of exactly the kind of single jurisdiction risk that dynastic families structure explicitly to avoid. A family whose entire net worth sits inside one country's banking system, denominated in one currency, subject to one government's emergency powers, is betting everything on that government behaving well during a crisis. Precisely the moment governments are historically most likely to behave badly, because crises are when emergency powers get invoked. Multi-generational families spread this risk across several dimensions simultaneously. Multiple citizenships and residency rights, obtained not for tax purposes primarily, though that's frequently a secondary benefit, but for what's sometimes called exit optionality. If a country becomes politically unstable, economically catastrophic, or simply hostile to a family's continued presence, a second or third passport is the difference between an orderly, planned relocation and a desperate scramble. Banking relationships across multiple jurisdictions. Swiss private banking has held a reputation for stability and discretion for over a century, in part because Switzerland has maintained political neutrality and monetary stability through wars and crises that devastated other nations' financial systems. A family with meaningful assets held outside their home country's banking system has a functioning financial life, even if their home country's banks are frozen or failing. Real estate in multiple stable jurisdictions, not as investment property in the ordinary sense, but as what amounts to insurance with a roof on it. A property in a politically stable country represents somewhere the family can physically go, live, and operate, even if their primary country of residence becomes uninhabitable, financially or otherwise. Trust structures domiciled offshore, which we've discussed in prior episodes primarily through the lens of tax efficiency and asset protection from lawsuits. During genuine economic collapse, offshore trusts serve an additional function. Assets held in a well-structured trust in a stable jurisdiction are generally insulated from the domestic legal and political chaos that might otherwise expose those same assets to emergency taxation, capital controls, or confiscation in the family's home country. It's worth being precise here about what this is and isn't. This is not, in any legitimate family office context, about evading legal obligations. Reputable structures are fully compliant with disclosure and tax law in every relevant jurisdiction. What it is about is refusing to concentrate existential risk in a single government's hands, the same way you wouldn't put a family's entire net worth into a single stock. The Wallenberg family of Sweden offers an interesting historical case study here. Having preserved and grown their industrial holdings across multiple Swedish and international entities, through a century that included 2 world wars and numerous European currency crises. A track record widely cited in family governance literature. Though, as with any century-long institutional history, the internal decision-making specifics are less publicly documented than the outcomes themselves. The information edge. How family offices see the crash coming early. We touched on information asymmetry in Section 1 through a historical lens. Now let's look at how it functions today, structurally, inside a modern family office. The single biggest predictive advantage old money families have over ordinary households isn't access to some secret data feed. In the modern era, most raw economic data is publicly available to anyone. The advantage is interpretation infrastructure. Dedicated professional staff whose entire job is to read that public data, cross-reference it against the family's specific holdings, and translate it into action, weeks or months before the implications become obvious to the general public. A well-resourced family office typically maintains relationships with economists, monitors credit market indicators most retail investors never look at, corporate bond spread widening, repo market stress, yield curve inversions, commercial paper issuance volumes, and treats early warning signs not as interesting trivia, but as direct triggers for portfolio action. By the time a recession is confirmed in headlines, it has typically already been underway for months. The family office's job is to be positioning before that confirmation, not after. This is different from insider trading, and it's worth being explicit about that distinction, because the line gets blurred in popular imagination. What we're describing is superior analysis of public information, not access to material non-public information. The latter is illegal and has ended careers and destroyed reputations, even within old money families who assumed their status made them untouchable. The edge is diligence and infrastructure, not secrets. There's also a social dimension to this information edge that's rarely discussed outside old money circles themselves. We've covered the silent currency, social capital, in a previous episode, and its relevance here is direct. A family with deep, trusted relationships across banking, law, politics, and industry gets a texture of information no public data feed provides. Not tips in the illegal sense, but genuine, aggregated pattern recognition. A banker mentioning that corporate clients are drawing down credit lines faster than usual, a lawyer noting an unusual spike in restructuring inquiries, an industrialist mentioning that order backlogs are thinning. None of this is a single smoking gun. All of it, aggregated across a well-connected family's network, paints a picture of underlying economic stress well before it shows up in official statistics. This is why old money families place such enormous, sometimes seemingly disproportionate emphasis on relationship building and network maintenance, a topic we've covered extensively in our episode on old money connections. It isn't purely social. The network is a distributed early warning system, and maintaining it, showing up, staying connected, being trustworthy enough that people share honest information rather than polished public messaging, is treated as seriously as any formal investment activity. Family constitutions, which we've also covered in depth, frequently include explicit governance provisions requiring the family office to maintain and report on a defined set of macroeconomic indicators to family principals on a regular schedule, turning what might otherwise be an informal habit into an institutionalized, board-level responsibility that survives any single generation's individual diligence or lack thereof. We go much deeper into how these family networks actually function, who's in the room, how trust gets built across generations, in our full episode on social capital, linked above and in the description. If you're finding value in this level of detail, now's a good moment to hit subscribe so you don't miss the next one. Training the heirs. Why the next generation is prepared for scarcity, not just wealth. Every mechanism we've covered so far, the reserves, the diversification, the network, is only as durable as the people responsible for maintaining it. And this is where old money planning diverges most sharply from how most wealthy families, old or new, actually operate. There's a pattern researchers have long observed in family wealth. A large share of family wealth is dissipated by the end of the second generation, and the vast majority is gone by the end of the third. This figure gets cited constantly, and it should be flagged clearly here. The specific numbers vary by study, and the underlying methodology is genuinely contested, so treat any single percentage cautiously. But the directional finding, that most fortunes fail to survive multiple generations intact, is well supported across a range of independent research. What almost all of that research agrees on is the primary cause of collapse. Not bad investments, not economic downturns, not even taxes. The overwhelming majority of multi-generational wealth failures trace back to heirs who were never actually prepared to steward the wealth they inherited, psychologically, practically, or philosophically. This is why the families who do survive multiple generations invest so heavily and so deliberately in what amounts to scarcity training, delivered in a controlled, calculated way, often starting well before adulthood. We covered the foundational version of this in our episode on the 12 financial habits old money children learn before 18. Habits like understated consumption, delayed gratification, and discomfort with visible extravagance. What's specific to crisis preparation is a further layer. Heirs in serious old money families are frequently walked through the family's actual history of surviving past downturns, not as abstract stories, but as case studies with real financial detail. What the family held going into the crisis, what they sold, what they bought, what mistakes were made and corrected. This is sometimes done through formal family governance structures, the family constitution again playing a role here, and sometimes through informal but very deliberate storytelling at family gatherings, ensuring that institutional memory of how the family survives collapse doesn't die with the generation that lived through it. There's also a documented, though we should flag the specific replication concerns here, line of psychological research suggesting that children who develop strong delayed gratification capacities early in life show better outcomes later on, most famously associated with the marshmallow experiments of the 1960s and 70s. It's worth noting that later, larger replication studies significantly complicated the original findings, suggesting environmental stability and trust, not willpower alone, may be the bigger driver of those outcomes. Old money families, whether or not they're aware of the academic debate, seem to have intuited something adjacent to this for centuries. They don't just teach children to delay gratification in the abstract, they build stable, trust-based environments where patience is consistently, visibly rewarded, generation after generation, which is arguably the more durable lesson. There's a harder edge to this training too, one we've touched on in our Black Sheep Protocol episode. Incentive trusts and spendthrift provisions that deliberately withhold full access to capital until an heir demonstrates specific competencies, sometimes including direct experience managing a business through a downturn, or successfully executing a crisis buying strategy on a smaller, supervised scale before ever being trusted with the family's full capital. This isn't about punishment. It's risk management applied to the single largest variable in the entire system: human judgment under pressure. The rebuilding playbook. What happens in the months after the crash? Everything we've discussed so far is about the years leading up to a collapse. This final section is about the specific, active playbook families execute in the months during and immediately after one. Because preparation without a deployment plan is just expensive caution. The first move, once a crisis has clearly arrived, is triage. Not panic, not paralysis, but a rapid, pre-agreed-upon assessment of exactly which family holdings are genuinely at risk versus which are simply experiencing paper losses that will recover. This distinction matters enormously and is where undisciplined capital gets destroyed. A temporary decline in the market value of a debt-free, cash-flowing asset is not the same kind of event as a leveraged position facing an actual margin call, or a business facing an actual liquidity crisis. Families with a pre-agreed framework for this distinction move fast and calmly. Families without one often make the same panicked, value-destroying decisions as everyone else. The second move is deployment of the dry powder reserve discussed in Section 3. And this is where the discipline built over years of underperforming on paper during good times finally pays off. This deployment is rarely opportunistic or improvised. Well-run family offices typically maintain a standing list of target assets and target price levels, reviewed and updated during calm years, specifically so that when a crisis hits, the family isn't scrambling to figure out what to buy. They're executing a plan that's been sitting ready for exactly this moment. The third move, less discussed but critically important, is supporting the family's own operating businesses and key relationships through the downturn. Extending credit to a family enterprise that's temporarily illiquid but fundamentally sound, or, in some historical cases, extending informal support to trusted business partners and even competitors. Building the kind of relationship capital that pays dividends for decades afterward. This is where the silent currency, discussed in Section 5, compounds. A family known for being a stable, reliable counterparty during a crisis, rather than a panicked, unreliable one, becomes a preferred partner for the best opportunities in the recovery that follows. The fourth and final move is patience through the recovery. One of the most consistent mistakes even wealthy families make is selling recovery stage assets too early, locking in modest gains instead of holding for the full multi-year recovery that historically follows major downturns. Old money discipline here mirrors the discipline required to build the reserve in the first place. The willingness to hold a position for years, resisting the urge to declare victory the moment prices tick back into positive territory. Zoom out across all 7 sections of this video, and a single pattern emerges. Old money families don't survive economic collapse because they predict the future better than anyone else. Nobody does, reliably, over and over, across centuries. They survive because they've built a structure that doesn't depend on prediction, cash reserves that don't care when the crisis arrives, asset diversification that doesn't care which sector gets hit hardest, geographic spread that doesn't care which government mismanages its own crisis, a network that surfaces early warning regardless of headlines, and heirs trained to act on the plan instead of their own panic. None of it is secret. None of it requires insider access or extraordinary intelligence. It requires discipline sustained across decades, structural humility about what can't be predicted, and a willingness to look conservative, sometimes for years at a stretch, in exchange for being the one family still standing and still buying when everyone else is forced to sell. This isn't hidden, it's just never taught. If you want to go deeper into how these families structure the actual legal vehicles behind this, the trusts, the shelf companies, the constitutions, the full catalog is linked in the description, and it's genuinely the most requested content on this channel. Subscribe if you haven't, and I'll see you in the next one.